Welcome back to the channel, and thank you for joining me. I'm Algabot, and in this session we're going to break down an expert advisor for MetaTrader 5 called Pullback Depth Continuation. This is a trend-following approach that waits for a healthy dip inside an existing trend, then looks to join the move as it resumes. It leans on two familiar tools, an exponential moving average to read the trend, and the average true range to measure how deep a pullback really is. By the end, you'll understand its entries, its exits, and the code that drives it. Let's dive in. So what exactly does this strategy do? At its heart, Pullback Depth Continuation is a trend-following system that aims to buy dips in an uptrend and sell rallies in a downtrend. It's built to run on a single time frame of your choosing, and it can be applied to many markets, major currency pairs, indices, metals, or other instruments your broker offers. Whatever chart you attach it to, the logic stays the same. The engine behind it is straightforward. A single exponential moving average, set to 50 periods by default, defines the trend. When price sits above a rising average, the strategy considers the market to be in an uptrend and will only look for long setups. When price sits below a falling average, it sees a downtrend and looks only for shorts. It never trades against the prevailing direction. The second ingredient is the average true range, or ATR. Rather than judging a pullback by an oscillator or a fixed number of pips, the strategy measures how far price has retraced from its recent swing extreme and expresses that distance in ATRs. This normalization is the clever part. It lets the same rule behave consistently whether the market is calm or volatile. Who is this style suited to from an educational standpoint? It tends to appeal to traders who prefer structured, rule-based entries and who are comfortable waiting patiently for the trend, the depth, and the timing to line up. Everything here is defined in advance. The trend filter, the acceptable depth of a dip, the stop, and the target. Remember, though, that no approach removes risk. Trading involves the real possibility of loss, and this video is educational information only, not financial advice. Let's walk through the mechanics step by step. Everything happens once per completed bar, so the strategy reacts to closed candles rather than every flicker of price. First, the regime filter. The EA calculates the 50-period exponential moving average and also checks where that average sat a few bars ago, 3 bars by default, set by the slope lookback. For a long, two things must be true at once. The last close must be above the moving average, and the average must be higher than it was 3 bars earlier, meaning it's rising. For a short, the mirror applies, price below a falling average. If neither is true, nothing happens. Second, the pullback depth. The strategy scans the last 8 bars, the pullback lookback, and finds the highest high for longs or the lowest low for shorts. That's the recent swing extreme. It then measures how far the current close has retraced from that extreme and divides by the ATR to express the depth in volatility units. For the setup to qualify, that depth must fall inside the value band, at least the minimum of 0.6 ATR and no more than the maximum of 2.5 ATR. A dip shallower than that isn't meaningful. One deeper than that suggests the trend may be breaking, so it's skipped. Third, the resumption signal. Even with trend and depth aligned, the EA waits for the just closed bar to print in the trend's direction. A bullish close for a long, a bearish close for a short. That's the cue that the pullback is ending and the trend is resuming. Now the exits, and there are 3. When a position opens, the stop loss is placed 1.5 ATRs away, set by the stop multiplier. The take profit sits at a reward to risk multiple of that distance, 2 to 1 by default, so the target is twice the risk. On top of those, an active trend flip exit closes the trade early if price closes back through the moving average, because the original premise is gone. A cooldown of 2 bars spaces out entries, and the EA holds just one position at a time. Let's read the MQL5 exactly as it appears in MetaEditor. At the top are the inputs, and these mirror the C# parameters one for one. You can see the trend EMA period of 50, the slope lookback of 3, the pullback lookback of 8, and the value band running from a minimum of 0.6 ATR to a maximum of 2.5. Below those sit the ATR period of 14, a stop multiplier of 1.5, a reward to risk of 2, a cooldown of 2 bars, and a fixed position size of 1/10 of a lot. Now the long block. The condition reads, if uptrend and bull bar. Inside it, the code computes depth as the swing high minus the last close, divided by ATR. If that depth lands between the minimum and maximum pullback values, it calls enter with true for long. Enter then reads the ask price, sets the stop-loss 1 risk distance below it, sets the take profit at the reward to risk multiple above it, and sends the order with trade.buy. The short block is the exact mirror. If downtrend and bear bar, depth becomes the last close minus the swing low, divided by ATR. If it sits inside the same band, enter is called with false. This time the code reads the bid, places the stop 1 risk distance above, sets the take profit the same multiple below, and sends the order with trade.sell. Notice both sides use the identical depth rule and the identical risk framework. Only the direction changes. Let's bring this to life on the chart. Running through the price action, you can see the trend EMA drawn as a smooth blue line, and our story begins on the left with a clean uptrend. The first few candles climb steadily, each one closing above that rising average. This is exactly the regime the strategy waits for. Price above a moving average that is clearly sloping upward over the last 3 bars. As price pushes higher, it prints a fresh swing high. Watch what happens next. The market pauses and pulls back. 2 red candles retrace off that high, dipping back toward the EMA, but crucially not through it. This is the dip the strategy is looking for. Behind the scenes, the EA is scanning the last 8 bars for that swing high, measuring how far this pullback has traveled from it, and dividing by the ATR. Here the retracement lands neatly inside the value band, deeper than the minimum of 0.6 ATR, yet shallower than the maximum of 2.5, so it counts as a healthy dip rather than a trend breakdown. Now the timing piece. On the next candle, price closes back up, a bullish bar that tells the strategy the pullback is ending and the trend is resuming. All 3 conditions are aligned now. Rising trend, measured depth, bullish close, and the buy entry marker appears. At that moment, the strategy sets its stop 1.5 ATRs below the entry, tucked beneath the recent dip, and it projects a take profit at twice that distance, a reward to risk of 2 to 1. Follow the candles that come next. Price lifts away from the entry, 1 green candle after another, riding the resumption of the trend. A couple of bars later, it reaches the take profit target, and the long trade is closed for a gain in this illustration. Now the market character changes. Price rolls over, and a red candle finally closes back below the EMA. The average itself begins to turn lower. This flips the regime. The strategy now sees a downtrend and will only consider shorts. Price presses down and carves out a fresh swing low. Then comes the countermove. A strong green candle rallies back up toward the EMA, but notice how it stalls right at the underside of that falling average and gets rejected. This is the rally in a downtrend that the strategy wants to sell. It measures the distance from the recent swing low up to the current close in ATRs, and again the depth sits inside the same value band, between 0.6 and 2.5. On the following candle, price prints a bearish close, the resumption signal for a short. The sell entry marker appears. Just as before, the risk framework is symmetrical. The stop is placed 1.5 ATRs above the entry, above the rejected rally, and the take profit is projected 2 times the risk below. From there, price slides lower, candle by candle, away from the entry and down toward the target. It reaches the take profit, and the short trade is closed in this example. Notice the symmetry across both trades. The same trend filter, the same measured depth rule, the same 2 to 1 reward framework, simply mirrored for direction. And had price closed back through the EMA while either trade was open, the trend flip exit would have stepped in to close it early. And that brings us to the end of our breakdown. Today we explored pullback depth continuation, how it uses a 50-period EMA to define the trend, how it measures the depth of a pullback in ATRs to find a healthy dip, and how it waits for a resumption candle before entering, with an ATR stop, a 2 to 1 take profit, and a trend flip exit to manage the trade. We walk through both a long and a short example, and we read the MQL5 code that makes it work. Please remember that everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses are part of it. If you found this useful, a like, a comment, and a subscribe genuinely help the channel, and you can find more strategy breakdowns at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.